What do we have? 880 or so on the Nifty and 84,200 on the Sensex. So those are opening rates. The Sensex is up 0.4%. The small cap index is up 0.4% as well. So you got 2:1 in terms of advances to decline ratio coming up on our screens right now. 66 now on the Nifty and about 288 on the Sensex. It's a much better start as compared to yesterday. Yesterday, of course, was a goner till, of course, those comments from Sergio Gore came and the market took a U-turn. Well, the Nifty heat map should come up, give you a quick sense of where we are starting before we go any further. First rates, Eternal, Infosys, HCL on one end. On the other side, you've got Dr. Reddy's, HDFC Life and L&T, which are coming up as some losses. Rima.
Well, HDFC Bank is moving with some strength. Today, there's a CLSA note on HDFC Bank. They say, since the Q3 operational update, the stock has corrected 6 to 7%. They believe that most of the issues are either misconceived or temporary. FY27 is likely to be a bounce back year for the bank. And with the recent correction, the stock is now trading at a discount of 10 to 12% price to book to ICICI Bank. They say it's time for the investors to overlook the noise and buy this great franchise. So HDFC Bank is one of the big movers. Putting the spotlight on the IT names, HCLTech had a positive start, but gains are now more tempered, just up close to about 0.5%. TCS in also absolutely flat. So no big gains coming through, but there is buying visible in Tech Mahindra and Infosys. Both these names are up nearly 2/3 of a percentage point. ONGC is now the big mover. ONGC is nearly up 1%. Strength seen in Eicher Motors. The rally on Hindalco continues. Since the start of the year, Hindalco is up 4.5%. Avenue Supermart seeing some green to begin trade with. On the way down, softness seen in HDFC Life, Max Healthcare, Tata Steel, Interglobe Aviation, Cipla, Dr. Reddy's. These are some stocks with cuts of nearly about 0.5%.
Well, from the broader markets, plenty of stocks are doing a jig of their own. So let's get a few of them up for you on the screen. JTL, well, that's taken a bit of a break. Yesterday, the stock was up close to 20%. They had won a large order, but the stock was up 20% today. It's seen some kind of pressure, some kind of recovery actually from the lows of the day. So JTL, the stock we keep an eye out on. Embassy Development, that stock is up close to 2%. Volume's quite large on that one. Billion Brains Garage Ventures, that's Grow. That stock, in fact, is up close to around 1%, but volumes are fairly large on that particular name. MRPL, as well as CPCL, both of them saw a big bounce up, but both of them have corrected a fair bit. Now, Q3 numbers could still be pretty strong, so interesting to see what the stocks do from here on. For the time being, MRPL is up close to around 3%, and I think Chennai Petro as well did see a bit of a bounce even in yesterday's trading session. So these stocks, remember, they've corrected close to 20% from the recent peak. GPTL Hathway, well, that stock is bursting away. That reacts to its numbers. It explains why that stock, in fact, is up and about in today's trading session. And another stock, Balu Forge, don't talk about this name very often, but this one, in fact, a few sessions ago, I think it was down close to around 18-20%. That's bounced back, and even in today's trading session, it's up close to around 5% as we speak. Frontline names that are moving up, GMDC has returned back to its winning base. Very volatile stock, had corrected close to 15% from the top. Now it's back to its winning base, up close to around 3%. And Ola as well is making it to the winners list. Well, that stock is up close to around 2%. Net, a positive start. Breadth of the market is heartening. Close to around 6 stocks advancing for one stock that's declining. Prashant.
KPI Green is coming up with some gains, 4% higher. Had a very, very volatile move after the deal was announced. Basically, had a big up move, then a big down move to below from where the deal was announced, and now it's coming back a little bit. 460 on this one. Angel One is up about 2.33%. There is MRPL, which is coming up with about a 2.5% gain right now. The GVTND is up 2%. I mean, sold off hard yesterday, and that is coming up with some gains. PVR Inox is up about 2.5%. And so it goes. So, I mean, these are first rates coming up. Very few names are down, and, even lesser with any volume, significant volumes at all. So, nothing very much. L&T is down 1.33%, and it's got some volumes on it. I think there's some information which I think we'll put out with Vivek in just a bit from now. So, that's what's coming through. Manish Gunwani is with us, Head of Equity, Bandhan AMC. Manish, good morning. Great to have you with us here. Thank you very much for joining us. 60 points and a little bit of a rebound and some breathing space, I guess, right, after those comments and the U-turn yesterday. It's been pretty bad to start to 2026, Manish. How are you thinking about markets?
Yeah, Prashant, I think we are in a bit of a very peculiar macro situation right now. The thing is, Indians are buying stocks and gold, which are, in a sense, both imported, which is putting a lot of pressure on balance of payments, which is in turn putting pressure on currency. And that pressure on currency is discouraging foreigners to come partially into the stock market. So I think this loop needs to break. It could break by dollar weakening globally. It could weak by a bit of rupee depreciation. But yes, tactically, it does look like we are caught in this loop at this point of time. It's peculiar because actually gold going up improves the balance sheet of India. I mean, we are the biggest owners of gold and silver. So structurally, it should be very positive for India that gold prices go up. But at this point, definitely there is some pressure on the currency, I think, which is discouraging foreigners from buying Indian equities.
Manish, other than the currency issue, which is plaguing foreigner interest in India, is it just the sentiment towards India that is hit? Or do you think fundamentally also, other than the currency issue, there are factors which are keeping investors at bay and keeping our returns in check?
No, there are. One is, of course, we don't have any big AI play. And China, Korea, Taiwan, which are the big weights in emerging market index, they have very big companies in AI. Second is this US-India agreement thing, which increases risk premium for India. It's not a very big impact on the economy, but it definitely increases the risk premium, especially in the perception of foreigners. So yes, there are obviously factors beyond the currency. Earning growth is steady, but nothing exceptional. The point is, last 5 years, Nifty 50 earnings have outperformed nominal GDP. So you can't take a 2-3 year view that earnings will be anything spectacular. So there are a lot of things, but the good part is, as I said, that the macro stability at current account level, the inflation level, the household balance sheet, especially with this rise in government, there are positives as well. So we just need to, I think, wait out the storm of this balance of payments being negative. It is actually also transmitting to monetary policy that while we cut rates, the volumes, etc., are not really coming back.
All right. Hi, Manish. Good morning and good to see you in. Manish, I recall last year, you were talking about maybe the small cap index is a good place to be into.
Yeah.
And maybe, in fact, the hope is that the small and the mid caps do better in 2026 because that's what makes portfolios feel good. So when you're allocating fresh money, do you think that these broader markets are actually providing an opportunity, or do you believe they still have more pain from here on?
Yeah, I mean, we definitely think small cap space is very interesting. And obviously, as prices have corrected both in time and price, let's say versus 1 year back, we're more positive on small cap today. We continue to believe that on a 3-5 year basis, that is the asset class which will outperform because, as I said, for large cap, the issue is if earnings have already outperformed nominal GDP for last 5 years, then the best hope is they will mimic nominal GDP of, let's say, 10-11% over the next 3-5 years. Whereas in small cap, because it's such a wide universe, there's a lot of technology change, there's a lot of geopolitical change, there are different themes you can play. So we do believe that a lot of small caps are incrementally getting into very attractive zone. But as I said, tactically, you need to see a bit of currency stability. We all know that when liquidity gets tight, small caps will not work. And we are in that situation at this point of time where if your balance of payments is negative, obviously liquidity will not be great. So we just need to time our exposure. But beyond a point, you can't predict macro. So we keep buying gradually we are reducing cash levels in our fund, which were relatively high, let's say 3 or 6 months back. So incrementally, definitely, I think exposure to small cap should go up.
Okay, and what's the current cash levels, Manish? Since you said that you have reduced it relatively, what was it 6 months ago, and currently what are the cash levels?
So this is fact sheet data of the small cap fund. We used to have 14-15% cash level. It is reasonably below that right now.
You're saying, Manish, that you would allocate more towards mid and small caps now? Yes. That's what you're saying, Manish, incrementally?
Yes.
Okay. Many of your colleagues across the industry are doing the opposite, Manish. They're increasing exposure to large caps. I mean, is that... Yeah, sorry, go on.
Look, it's not so much a tactical call. As I said, there are macro challenges for India. But the point is, if I take the universe that is available in small cap, I think the large and mid cap spaces are very restricted. And as I said, their earnings growth tends to mimic nominal GDP growth, which will not be anything great.
No, let me clarify, Manish. Bulk of what I described, right? And the caveat is, I mean, what you do also depends on what you've already done in that sense, right? So if somebody has a lot of exposure, then you trim and then go large cap. But the motivation from what I kind of picked up is not so much about capital appreciation, it's capital preservation. Protect NAVs, I mean, that kind of thing. By going into large, I mean, that's the underlying thread I could pick up. Go on, sorry.
I think clearly over the last 15 months, we have seen, as I said, time price correction. Rupee has depreciated. So in dollar terms, we are probably for last 15 months the worst performing market globally. And I agree, next 3 to 6 months, maybe we might get a bit more correction. But I think, and we keep saying that the small cap space, you need to see on a 3 to 5 year basis. And bottom up, I think incrementally you are seeing stocks which can potentially double in the next 3 to 5 years in the small cap space. And that's usually a good return to have. So yeah, timing based on macro is one thing, but macro can change very fast. For example, if the Fed governor comes and cuts 50 bps, then all these liquidity issues will get sorted. So we can't really time macro beyond a point.
Yeah, no, we can't, absolutely, Manish. Would you want to identify, I mean, just talk about maybe a situation, a stock where you think, it's becoming obviously very, very attractive, just, I mean, and like at a throwaway valuation, just as an example, Manish.
Yeah, so a lot of the global cyclicals, because they've not been the focus of the market, whether it's metals or shipping, I think the global economy is doing very well. Everyone thought US will go into a recession. That's not happening. China's kind of gone through a massive property deflation coming out of that. And I think the global cyclicals like commodities and shipping, they are cheap versus what assumptions that are being factored into earning estimates. So I think that, for example, is a space that looks where your heads you win, tails you don't lose kind of situation. I think very cheap lenders, price to book 1 or below, that continues to remain an attractive space as well. Because in India, as I said, household balances is pretty okay, growth is pretty okay. So we don't expect any big asset quality issues in lending. I think small tech platforms also are interesting. So there are a host of things that look interesting.
All right, Manish, one sector that you all were bullish on, which you briefly mentioned, was the metal space. And I think the second half of last year were quite bullish. Last quarter as well, you reiterated that stance. From here on, how do you approach it? And how would you play it? Metals have seen a melt up. Gold as well is doing well. You also mentioned about financiers. Would you go the gold financiers route? Do you think the industrial metals have more to go from here on? And within that, what would it be? Ferrous and non-ferrous. Give us some color with regard to that metals play.
Okay, the drivers are different, but I think all are interesting spaces. I think gold finances are a bit expensive right now because I think all lenders can do gold finance if it's attractive, so beyond a point. But I think precious metals, obviously, a trade on global liquidity. And I continue to believe that the debasement of paper currencies will keep happening. I think industrial metals also look interesting. I think non-ferrous is different from ferrous. I think non-ferrous is more about China and Europe doing fiscal stimulus, US coming back, US continues to remain resilient. With protectionism, every country is doing capex, whether it's defense or semiconductors. The demand seems okay. Industrial metal stocks have run up, but maybe there's still some space to go. I think the ferrous space is a bit dependent on this anti-revolution thing with China and also the Chinese currency, right? I mean, I think some part of your portfolio has to be positioned for extended dollar decline versus yuan because both the hard numbers of current account and all, and the narrative about China now seeming to come out of this trade war pretty strongly. You could see yuan at 7, from 7 going to 6 or 5 over a period of time. Some part of your portfolio, which is probably steel, is the best on that. So I think the ferrous is a bit more dependent on what China wants to do in terms of capacity rationalization or how they want to handle the currency. The non-ferrous part is, I think, a bit more clear.
Absolutely. Interesting views there, Manish. It's always good to get that perspective and interesting conversation. We'll follow up on some of this in our next one. Thank you very much for joining us this morning here on CNBC-TV18. Okay, well, L&T is what we want to talk about, and there is news reports in global media suggesting that there could be some orders at risk from the Middle East. Vivek has got more details. Vivek, take it away.
Well, that's right. So L&T is in focus, like we've been highlighting. What actually transpired is that MEED, which is a Middle Eastern news publication, that has reported over the last couple of days that large orders, this is in the country of Kuwait, and Kuwait has started discussing cancellation of oil project tenders worth over $8.7 billion. Now, as per analysts and as per some of the data that we called out from both news reports as well as some of the order inflow announcements that the company has put out, we understand that from Kuwait itself, L&T in this particular order project pipeline, remember these are almost 6 to 7 large oil upstream projects, we understand that L&T was L1 or was favorably placed to win orders worth over $4.5 billion. So now this comes as a bit of a negative surprise, given the fact that the reason cited in the article for the likely cancellation of these orders is the fact that the order bids came in above what the Kuwait government or the Kuwait authority was actually anticipating. So this leads to a risk that there could be a sizing down, number one, of the order inflow, and number two, there could also be a cancellation of the order themselves. Now, early morning today, we've reached out to L&T as well. We are still waiting for a comment, but at this point of time, it's a slight negative development, and especially given the fact that L&T has been banking on the Middle East for further order inflows.
Thank you very much for that. On the flip side, Eternal is a big mover. Stock has surged close to about 3.5% now as we speak. So keep your eye on that. Very large volume, lots of buying seen there. And HCLTech and TCS opened up mildly higher, turned flat, and now decisively lower. HCLTech 1.5% gone. TCS up. TCS also down nearly about 0.6%. Remember, these are stocks which, like HCLTech, for instance, went up 12-13% in the last 3 months. So tactically, people maybe have turned bullish after the recent underperformance. So some of those gains may be getting paired off. But let's talk about the new labor codes, because in TCS and HCLTech's numbers, both the companies had to take a one-time impact, and quite sharp. In the case of TCS, it was more than 2,000 crore on the back of the new labor code. The Institute of Chartered Accountancy had directed companies that they must account for the impact of the new labor codes from Q3, so that's starting to play out. Sonal joins in with the details. Sonal.
Well, yes, ICI had notified and asked all the companies to account for the impact of labor laws starting Q3 itself. And so this is something which is not a surprise and was expected by the markets generally as well. They issued FAQs on key accounting implications arising from labor costs. And they said that 21st November is the date from which labor laws will be applicable. Still, there's more clarity required for different states. So gratuity pay, which is a 15-day pay for every year worked, paid at the time of employee leaving the organization, and leave encashment, basically the accumulated leaves which are paid to the employees at the time of leaving, these have to be considered in the corporate pay structure. Now remember, salary structures are usually structured in a way that cash in hand is more, right? And now the new definition says that 50% of the total pay must be basic pay, and so far most of the industries must be keeping the basic pay between 35 to 40%. This is as per Jefferies, which is basically 2/3 of the companies in the industry were doing that. So for compliance with the laws, a lot of these companies have changed the salary structure, and this would mean that they will have to raise the total compensation by 3 to 5% in order to keep cash in hand at similar levels as before. And around 45% of the banking and finance companies are expecting the impact to be more than 5%. Some of the other companies would expect it to be between 3 to 5%. But considering all the mitigation factors as well, Jefferies is of the view that total pay hike due to labor costs will be around 2%, and that is not as big as the street was fearing in general. According to them, the key stocks which could be impacted will be the ones which have higher India employee cost to the profit before tax ratio. There could be some recurring impact for some companies, and some of them would take a one-time hit on their P&L. These companies would include the capital goods company, BHEL, Afcons, L&T, retail, which have higher employees at the store as well, Jubilant, Nykaa, Eternal, IT companies, of course, you spoke about it earlier, pharma companies as well, and banks themselves have a higher proportion of employees which are paid. So these are some of the sectors and companies which could be impacted.
Thank you very much for that. We have with us Bala Subramaniam, a Senior Vice President, Team Lead Services, now joining in. Mr. Subramaniam, you want to, in a way, quantify the impact. And is this a big hit for the companies? This retrospectively, it's one time, but going ahead, is their annual recurring employee cost bill going to go up?
Hi, morning. Thank you so much for having me. As we speak, we are in the process of implementing the labor codes for all of our customers as well, and we have over 3,000 customers on a base of 3.5 lakh contract staff. And yes, the impact of the labor codes are such that there is unification and simplification of various non-CTC components, such as if you look at PF, ESI, statutory bonus, your gratuity, leave encashment, and all of these things have a unified and singular definition of what wages are. Because unfortunately, until before the labor codes, wages, the interpretation of wages was subjective. And now it's become just unified to one number, which is your total remuneration, which is your CTC. And because of the simplification, what ends up happening is that especially at the entry level, the cost of compliance, that is the PF components, and even the ESI bracket, that is the coverage of people under ESI, has gone up significantly. I'll just give you an example. If you look at how things were before the labor codes were implemented, up to 21,000 rupees of gross wages was the maximum limit under which a person would be covered under ESI. If you look at the entry level hiring in most formal jobs today, the salary should be just about 21,000, but below 42,000. But now they have made it 50% of total wages, which means whoever is even at 42,000 rupees of salary would still come under the ESI bracket. So ESI contribution is now an additional cost that companies have to bear in order to maintain the cash in hand or the net take home constant. So that's an additional cost. And apart from that, because the wages definition has been standardized now, the provident fund contribution has also gone up. But then when we did this calculation for, let me take the example of one large company for whom we implemented it very recently, on a base of 10,000 people, for about 4,000 people or so, the net take home actually went up. And for another 4,000 people, it actually went down, marginally though, right? Very, very marginally, but the overall CTC actually remained constant or slightly went up. So the cost may go up marginally, but then this is something that can be consumed within one increment cycle itself. So it's about making sure that this is absorbed within one increment cycle. Typically, companies pay out anywhere between 7 to 12% as annual increments, and it can be consumed well within that, and then we move on. So it gets regularized in just 1 year.
All right, let's get in Mr. Raghuvanshi as well into the conversation. Mr. Raghuvanshi, what do you make of these changes and the potential impact on companies?
Yeah, good morning, everyone. I think, the issue is that at one end, we are trying to, work on the ease of doing business, and codifying this new labor law is a positive step in that direction because it helps in several ways, especially with women in the workforce, enabling women in the workforce, and in several other ways, also creating a social security net for people in the gray collar or the blue collar job market. I think the issue is the cost of doing business as a result of this new labor law, which is going to go up significantly. And we have to remember in India, it's less than 7% of our people are in employment in the private sector. And these are jobs. So we're just basically increasing the cost of, employing people. And, that's going to have an impact on corporate margins. But I think it's going to be a little more nuanced. The Gratuity Act, the Payment of Gratuity Act 1972 limits the total amount to 20 lakhs. That doesn't mean that companies cannot pay more than that, but because of the income tax limit and the limit under the Payment of Gratuity Act, a lot of companies limit it to 20 lakhs. So I think you'll have to go company by company, analyze their annual reports to see what their gratuity computation rules are.
Mr. Subramaniam, I've just come in on the increased cost of doing business now. Particularly, the fear was the hit to quick commerce companies because they employ a lot more gig workers who would now come under the Social Security ambit. Now, Team Lease has also been providing, for your gig workers, quick commerce has been a big source of growth engine. It's been a big source. So can you give us some indication of the increased cost structure for them?
Not really sure if the overall cost of ownership, the total cost of ownership will actually go up even for gig workers. And the reason for this is because most, if not all of the platforms who employ gig workers or the logistics companies for that matter have been providing some form of insurance / coverage for them or the other. Now, what are really the demands that they have? You look at it in a fourfold manner. They look for health cover, accident cover, life cover, and retirement benefits. It's not like they have not been provided these things so far. It is just that companies at their own discretion have been providing them at a significant cost because they have been providing them through third-party insurers. If the government can step in, as they have announced as part of the Code on Social Security, and ensure some sort of cover and social security benefits for these people, then it's just a substitution of cost. Instead of paying insurers, you pay the government. And the government will be able to provide benefits, hopefully disproportionately compared to what insurers can. If you look at ESI, for example, the government has not really announced if the contribution from gig workers or towards gig workers will be made specifically towards PF or ESI. But I'll just give you the example of ESI. It gives unlimited cashless health cover for self and up to 7 people in the family. How many people even know this? And that's something that only the government can provide. No insurance company will be able to provide that. So it's just a cost substitution, like I said earlier, where instead of paying private parties, you're going to pay the government, and the benefit should probably be the same or hopefully will go up.
Okay, gentlemen, we'll leave the conversation here. Thank you very much for joining in. For today, we are seeing HCLTech and TCS perhaps reel under the impact of the new labor code, which has impacted the company's bottom line. For TCS, it's more than 2,100 crore. For HCLTech is a number in excess of 700 crore rupees, which is why both the companies missed estimates on the bottom line. Operationally, it was a good set of numbers, but all in all, these are companies which are not growing very fast. As Nomura pointed out, for TCS, the dollar revenue growth estimate, Nomura on TCS, is minus 0.7% this year, and that will go up maybe marginally next year, 2.5%, 3%. So these are still slow-growing companies. Even for HCLTech, on the whole, the revenue growth this year will be 4 to 5%. So which is why maybe investors are still on the sidelines, and these company stocks actually did well in the October to December period where there was a bit of a catch-up rally. So we had a conversation with HCLTech CEO and MD C. Vijay Kumar, CVK, and CFO Shiv Walia, and we began by asking CVK more about FY27. What are the leading indicators suggesting Will the momentum continue? Can FY27 be better than FY26? Listen in.
We've delivered a very, very strong quarter on all dimensions. And this is the second consecutive quarter of strong performance. So I think FY27, as you know, there is so many moving parts in the world. There's a lot of volatility. But what I can reasonably share is some of the leading indicators that we have. We have done very well in the last 2 quarters. And given the strong bookings in the Q2 and Q3, the Q2, Q3 booking is almost 30% higher than in the same period last year. So we are looking at some good uptick in revenue in Q4 in the services, and then of course Q1 as well. So I think given our booking, given our pipeline, and all the momentum that we have, we are looking at a good outcome in the next year. However, anything specific, we will really have to wait for the April meetings.
Shiv, there is this one-time impact on the back of the new labor code. But beyond that, what is the anticipated recurring income on the annual employee costs?
It's going to be minimal. We have taken the one-time drop charge. It's going to be maybe 10 to, at best, maybe 20 basis point going forward. So we don't expect impact beyond that.
Okay, so 10 to 20 basis points. And on restructuring for FY26, what will be the total restructuring cost? But could you put that in rupee crore and the impact that you expect on margin shift? And will this restructuring cost continue into FY27? And what happens to, is there a possibility that if it doesn't, your margins can get back to the 18-19% band?
So as I indicated last quarter, the overall cost of restructuring is going to be around 50 basis point this year. We have done most of it, and hopefully the next quarter is also going to be the similar charge, around 40 to 50 basis point. Our endeavor is to complete this exercise this year and move to next year with a clean slate. So I don't think that's our endeavor, but we'll update you when we close our year in April.
Okay. So the overall impact in Q4 will be 40 to 50 basis points. And for FY26 also on margins, it should be about 50 basis points, correct?
So the full year is 50 basis point. Yeah. And next in Q4 is going to be similar to what we had this quarter. Q3 is around maybe 60 to 80 basis point.
CVK, what has been the achievement out of this restructuring exercise that you've undertaken in terms of the overall employee headcount, in terms of utilization of your workspaces? Can you give us at the end of it, what have you achieved?
So I think in Q1, we saw a little bit of mismatch between skills and location where the people were available. And we also had some underperformance in some of our acquisitions, especially in the automotive segment in some of the Western geographies. So we have optimized some of this in the last couple of quarters. And that's what you see the restructuring costs are. Facilities as well across the world, there are many facilities which are not being fully utilized. So we have done some rationalization. All of this is has been the part of the plan since the beginning of Q2.
But have you had to let go of people on the back of this restructuring? If yes, what's the number?
Yes, we have had some very small numbers. We haven't called out any specific number, but largely it's outside India in some of our geographies. We've had some exits for sure.
This year, the guidance does not include the acquisitions that you've done, Jaspersoft, HPE. But next year, what will be the contribution of the acquisition?
It should contribute at least 1.5% in FY27, assuming things close by end of this year, which is by March or early April. Roughly 1.5% growth to the overall company is what we expect.
Will you continue to make acquisitions, bigger, bolder ones in size, perhaps?
We're not really looking at scale acquisitions. It's really capability-led or some geographies where we really want to accelerate our presence. That's where we will be looking at acquisitions. We don't think we're going to do a very large-scale acquisition. I don't think that's in our plan.
And getting back to margins of 18 to 19%, does that happen in FY27?
Even this year, Rima, we are, if you take out the restructuring cost, we're only some 10, 11 basis points off this quarter after taking out the restructuring cost. So we feel pretty confident of getting to our 18 to 19% range in the next year.
Oh, that's good to hear. And a little more on AI. Now, it's been 2 quarters since you've been sharing the advanced AI revenues. It's about 4% of your overall consolidated revenue, growing very fast. What is the momentum that you're seeing on AI? And, what can that number in terms of revenue contribution go up to?
Yeah, I think there are 2 aspects to this. One is advanced AI, which is really a lot of work which is required to get AI infrastructure enabled, the silicon work that we do to build, design edge inferencing chips, some of the agentic solutions, some of the IP that we have in AI. That's really what we call as advanced AI revenue. But we have a much broader canvas where we have deployed AI in service transformation, application modernization, data lifecycle. So it's a much bigger canvas when you consider AI. And we think almost every part of our business should get significantly influenced by AI as the time progresses. But advanced AI is really a leading activities like build out of data centers, all the professional services around design and implementation of data centers, silicon, and all the IPs that we have built. All of that is what we call out. We think there is a strong momentum. It's growing now 20%. Even the previous quarter, it grew even higher because we had just called out, we exceeded 100 million, but now we are at 147, 148 million per quarter. We think there is enough fundamental reasons why this will continue to grow at this speed for a few quarters.
That is HCLTech saying that the momentum should continue in Q4 and Q1. FY27 margins should get back to 18 to 19%, which is higher than the guided band of 17 to 18% this year. And next year, the acquisitions done by the company will benefit their top line by 150 basis points at least. And going forward, the new labor code will have a very limited impact on the company's cost structure. Margins could be impacted to the tune of 10 to 20 basis points. So that's the summary coming in from HCLTech. Get into a break. On the other side, Somil Mehta of Mirae Asset Sharekhan joins in for some technical trading ideas.
Welcome back. Somil Mehta is with us of Mirae Asset Sharekhan. He's joining in with what he'd want you to do as far as approaching the market goes. I mean, we're off the highs and I think the market's now in the red. Reliance, I think, is one reason. It's down 1% again. Heavyweight, which is having outsized influence as always. Somil, what's the recommendation? I mean, sentiment still is fragile, even though we saw that rebound yesterday. But in terms of taking trades, what would you recommend?
Hey, hi, good morning to everyone. Now the trend remains negative on the in the short term. Trading below Nifty, trading below 20 and 40 daily moving average. A sell-off which we saw in the last week has broken an upward sloping trend line on the daily charts. The entire the consolidation which we saw between 26,300 and 25,700, that has broken on the downside. The structure has looking a little weak from here. Now, the resistance from here is 26,000, which is the 20 daily moving average, and I'm not expecting markets to go above that. So my view remains negative in the short term. However, in the medium term outlook, we are still on the positive side, and I'm not expecting, too much of a sell-off from here. But on the downside, my targets would be 25,300 and 25,200, which is very close to a 200 daily exponential moving average on Nifty. So sell on rise should be the strategy in the very short term. And I think railways are looking really weak from here. However, metals and banking are looking flat to positive. So I'll be staying away from them. But mid caps are looking weak, definitely.
Anything on HCLTech, TCS? The numbers were not bad per se. TCS, you could say, were not exceptional, no big, positive surprise, but not negative either. And HCLTech, actually, we got a guidance upgrade at the services, the main services business. So what is it technically that the charts are looking weak, that we are seeing a correction today?
No, not on the IT side, not for HCLTech and TCS. There could be a little bit of correction in the very short term where it can go till HCL can go till 1580 levels, but not in the medium term outlook. Medium term outlook still remains positive, and I'm expecting the stock to take support at these 1550, 1580 levels, and then again start the up move. But in the very short term, yes, we have seen a sharp sell-off right now today, closing and trading below 20 daily moving average. So in the short term, yes, negative, but in the medium term outlook, it will be a buying opportunity around 1580 levels.
Yeah, got that. Your specific trades in terms of stocks, Saman?
My first trade would be on IRFC. IRFC is trading below 200 daily moving average. Have already started low top, low bottom formation. A small consolidation has also broken on the downside. So the stop loss would be 127 and the target would be 112. So that would be my first trade. The second one is Hudco. Hudco, very similar, very sharp bounce we've seen in the last couple of months. And then now again, a sharp sell-off closing below 200 daily moving average. My stop loss would be 220 and my target would be 205.
Yeah, those are individual trades. Samal, do you have a technical view on Reliance?
Reliance, very similar to Nifty actually, because it was trading in a very broad range of 1520 and 1600 levels. So that range has broken on the downside, forming low tops, low bottom, trading below the averages. Now, very crucial levels at 1430, 1450 levels for Reliance. I'm not expecting that to break on the downside, but if it breaks on the downside, because I'm being a little cautious on the markets now, if it breaks on the downside, then the next level is 1300, 1330 levels. So sharp sell-offs if that crucial level breaks. So I'm hoping the medium-term levels to hold right now.
I mean, look at the market go, right? 87, 90 points lower now on the Nifty. As we were talking, and I think another 20, 25 points gone, Samal. So not being able to hold at all. With what we're seeing out there. I just have to say one thing though, so far, and maybe, this will also now follow what the Nifty is doing. Market breadth is still positive. So some 1700 stocks are higher and about 1100 stocks are lower. I'm talking about the NSE advanced decline ratio. Of course, I mean, the gap is converging and we'll see what happens. But for now, more up than down, even at this point in time. Just a few other names. MRPL is still holding with about a 3.5% gain. Ixigo is coming up with a 4% gain. I mean, these are all stocks which have seen large corrections. Ixigo high was about 350. It fell to about $200. So Ixigo is coming up. Jindal Stainless is up about 3.33%. Balaji Amines, fair bit of volatility recently around the 1,050 odd rupee levels. That is Balaji Amines. Rajratan Wires is up up 5% or so. So I mean, here and there some moves, but nothing very large per se. Dixon is coming up with some pressure. 2% lower on Dixon at this stage. There is what else? Glenmark, which is coming up with about a 3% cut. So that is meaningful on volumes on the downside. Senco is down about 1.75%, and then there is Misho, which is down about 2%. as well. So, well, broadly, you would recommend those if you're trading, especially if you're on the F&O side, etc. I mean, reduce position size and, I mean, you've got to be a lot more nimble.
Absolutely, absolutely. So, what my strategy would be to, if you're long, and if you're long, then stay on the large cap side. Don't go outside banking and metals, because those are the only sectors I'm looking as a very positive side right now. Not in railways, not in pharma. Also looking a little negative from here. Fortis giving up all the gains. Glenmark Pharma giving up all the gains. So I would stay with the large caps if I'm long, but if I want to go short, mid caps are going down. They are I'm expecting very sharp sell-offs in mid caps and small caps. So yeah, shorting opportunities definitely. Put options would be a great way to trade them, having a less risk on the side. But yes, going short would be the right strategy in the short term.
Short in the short term. Samal, thank you very much for joining us. Good speaking with you, and good to get those trading ideas. And broadly, I mean, the setup as things stand right now. We'll start to have a lot more budget conversations because the budget is 15 days out, right? Now, here's Chirag Shetalwad of HDFC Mutual Fund making a very pointed argument that maybe we should loosen the fiscal deficit as a percentage of GDP number a little bit. I mean, spend a little bit more like other countries have, and maybe this is the time to do it. Just listen in.
I think the budget, as you said, has lost relevance. But I'm sure post, I see the views post every single budget. Every budget has been a 8.5 to 9 on 10. Every budget has been growth oriented. Every budget has been sort of fiscally prudent. I think we got to go beyond it, right? We have 365 days for the government to introduce reforms and measures. Why are we focused on that single day? I think the key question, though, in more seriousness is how they view fiscal prudence, because this year your tax collections have been far below target and your expenditure still has to be cut fairly substantially in the next 4 months to meet your expenditure targets. So chances are you'll exceed your expenditure targets and you'll underplay your revenue targets. So the question is, will this government stick with its discipline on the fiscal side or not? And I think there are a lot of people, and I suspect I could be one of them, is maybe we shouldn't, right? We don't have to have this holy grail of fiscal discipline. If we're in an environment of uncertainty, maybe you loosen it up a little bit. Other economies have done that, so why can't we?
Get into a break. We'll keep hearing more from these conversations. For now, we'll slip into a break with the news that the Nifty is down about 50 odd points. Manisha Gupta will join in and put the spotlight on the commodity space. Stay tuned. Welcome back. As promised, let's talk commodities, and commodities on a high once again. Manisha is here to give us more details.
Thank you so much for that. Well, gold, silver, copper all trading near all-time highs, and platinum is up 15% in this year. But what is also running higher is the crude oil prices. If you look at the Brent and WTI numbers, we're looking at gains coming in for that one. So 64 plus, and Brent with that is trading at a 1-month highs. If you look at the WTI, that is the US crude oil prices, they are trading at a 7-week highs as well. Overall, the prices have gained up by 5% in this week alone. And this is after prices declined 18% in all over 2025. Well, 3 or 4 factors which really seem to be supporting the crude oil prices at this point in time. One clearly comes in from Iran, with US latest levy of 25% tariffs on Iran's trading partners with immediate effect has led to supply disruption concerns coming into the market, and that has led the prices higher. Remember, the US president also have warned of a possible military action against Iran. Now, Iran exports 2 million barrels per day, and it is 4th largest producer exporter when it comes to within the OPEC cartel. So important country there, and with what seems to be happening within the country and with the US statements, we are looking at that premium building up in case of crude oil prices. The second thing, of course, is about the uncertainty over Venezuela's crude shipments. While we do understand that there are US companies which are willing to now move crude oil from Venezuela and invest on a longer term as well, but the near-term uncertainty just about stays. Third point really comes in from Kazakhstan, because here as well, the oil output is affected by adverse weather, and it is not just about a week or 10 days. It has been happening for last 3 months or so, supporting prices. The Russia has been yet another strong one when it comes to crude, and even as it has been 3.5 years of war there, we've seen Russian crude more or less continue to go out. But the infrastructure damage that has been caused by Ukrainian drone attacks in the last 4 or 5 months has led to 16 to 17% of a decline therein. And then it also is about Azerbaijan, where the oil exports have declined on an year-on-year basis. Last year was 24.4. The year previous was 23.1 million barrels there. So we have seen constant declines from major OPEC producers there, supporting prices. Dollar index declining. It has been about macros as well, supportive. And then the street will also watch out for the US Supreme Court ruling on the legality of US tariffs. That announcement comes in on Wednesday. Having said that, when you look at the outlook for crude prices for 2026, it has been a very range-bound trend that the markets believe you could be looking at in this year. The first quarter, Street believes, is going to be of surplus, but going forward, then the demand will start coming back, and that is when you will see crude prices supportive as well. So between 60s is what UBS, Bernstein and DBS believe that you could be looking at the crude oil prices, $60 to $68 a barrel of a range forming there. But then the others are not so bullish. You have $55 of an average coming in from IEA, Goldman Sachs, ABN AMRO, Capital Economics, all of them believing that mid-50s is where the crude prices could be as an average for this year.
All right, Manisha, thank you very much for that. So that's oil price forecast into 2026. We'll take a quick commercial break here. Lata speaks with Macquarie Suresh Ganpati on what to expect from the banking, NBFC and insurance companies when they start posting numbers for the third quarter. Stay tuned.
Well, the IT companies have started the results season, but practically from today, tomorrow, it is going to become the finance companies that will hold the market's attention. Today's Bank of Maharashtra. Tomorrow, we have some insurance companies coming in. By 15th, you will have IOB, Union Bank, Indian Bank, a lot of banking, I think even Federal Bank. And by the weekend, that is Jan 17th, you're going to have ICICI and HDFC Bank also coming with the results. So we better understand what we are going to get from insurance, NBFCs and banks. Joining me is perhaps one of the best veterans to watch them, Suresh Ganapathy, Managing Director, Head of Financial Services Research at Macquarie Capital. Suresh, good morning, and thank you very much indeed for your time and for trying to put us a little ahead of the curve before the results come in. I want to start with your price target chart, which I saw in your latest report. The chart should come up on the screen. I mean, there is a sizable revision that you have made of the results of the price targets. I mean, some 100, 200 rupees for SBI have gone from 720 to 1150. For HDFC Life from 700 to 900. SBI Life, again, a huge 500 rupee price increase. Let me start with the insurance companies first, because there the price revision is high. Why are you so bullish on insurance companies?
Yeah, so look, I think what has happened here, if you look at the last couple of months itself, the sum assured growth numbers have been pretty good. Right, Lata? So clearly there is some good pickup in the protection numbers. Now, what's likely to happen here is the next couple of quarters is going to be a little bit more challenging because of the input tax credit. But I'm willing to look beyond the next 6 months because I think there is a lot of stability in this sector. We are going to see a lot more amount of reforms in terms of risk-based solvency measures, eventually getting implemented, moving towards an IFRS. And then eventually, if at all the protection growth sustains, which we believe could happen heading into FY27, that's going to be margin accretive. I mean, the volumes here are quite amazing, which is going on in this particular side of the business. And I think the market is missing the margin upside that can come from the protection business, because protection business margins are almost 4 times your company level margins.
Oh, I thought ULIPs give them more money. It's protection which gives them more money, is it?
Yes, indeed. Very high, because the protection margins are around 80 to 90%. The ULIP margins are just about 10% or so, Lata. So it's
like any AMC. Okay, yeah. I get your point. Okay, so one should look forward to that, because a lot of insurance companies are coming up with their numbers very soon. I think HDFC Life will be one first off the block. Let me then come to the NBFCs. I'll reserve the best for the last, the banks. In NBFCs, your report primarily says, don't look at the very large NBFCs because their growth could get challenged. Look for the low valuation and smaller NBFCs. Can you elaborate?
No, look, I mean, Lata, my point is there is a trade-off between growth and profitability. And of course, when you become really large, it becomes very difficult to sustain. So just to put in context, I'm just taking one example. Let's take, for example, Bajaj Finance. Now, in the non-mortgage portfolio, they generate closer to an ROA of about 5.5 to 6%. Now, you can't generate that ROA and keep growing at about 30% or 25%, right? At some point in time, you'll have to give way for the other. That is the reason I believe the opportunity is more in the smaller ones, which are trading at half or even lower than that in terms of its valuations. Growth is also pretty good, and there is no dilution of ROA. That's the reason the bias is a little bit more towards the mid-sized or smaller size NBFCs, which give you somewhat similar growth potential and with a stable ROA and at a lower valuation.
Okay. So what's the pick of the pack there?
So the two stocks which you're pushing is AB Capital and Shriram Finance.
Oh, okay. Shriram Finance, still a large one. But just a word more on Bajaj Finance, for instance, since that is the example you took. Yeah. Even in the last reported number, Bajaj Finance AUM grew by 24%. Their guidance is 19 to 20%.
No, 22 to 23.
Yeah, okay. If that is the kind of guidance they're giving, you still think that they will not be able to, match? I think they're talking about a 10 lakh crore AUM before 2030. If at the moment it is almost like Kotak Bank, it's like almost touching 5 lakh crore, 4.62 lakh crore in September.
Yeah.
Given this pace of growth, you still think that you would not put your eggs in that basket?
Yeah. So, of course, Lata, we are talking about the company which is growing at 30%, now having come down to 22, right? So there is a corresponding reduction in growth. Now, 22% is not a bad number, but you have to look at in the context of valuations and the downward revision of growth which has happened over the course of last 12 to 18 months. So that's one thing which we have to look at. Secondly, even though they may have a target of about 10 lakh crore AUM or which whatever growth that translates into, it's tough, Lata, to maintain that at 4% ROA.
Okay. No, I suppose size brings with it its own problems. Let me now come to the banks. Most interesting. I am getting a feeling from your report that you have turned very positive on public sector banks. Of course, a huge upgrade for SBI itself. But should we, the first set of numbers are coming from IOBs and some of the public sector banks. Are we in for something positive? In fact, Bank of Maharashtra today itself.
Yeah, so look, I think, Lata, one area where the public sector banks continue to do very well is they are gaining loan market share. So let's admit that they're growing faster and they don't have the kind of LDR constraint that a private sector bank has. Now, of course, the Reserve Bank of India is no longer looking at LDR as a big constraint right now because there is a change in the regime and an approach and liquidity environment and inflation. So whatever is the macro-related factors which is making them look at the LDR numbers a little bit more favorable. But PSU banks don't have that kind of a challenge. Point number one. Second thing here is, Lata, and here is where I think we have underestimated the extent of benign asset quality that we continue to see in the corporate credit quality. See, the advantage here is because public sector banks have a large 70-80% book in corporate, that continues to be squeaky clean. Today, the slippage numbers of some of the public sector banks, Lata, are lower than the credit cost numbers of some of the private sector banks. It's an extremely high level of anomaly and good situation that persists. I don't see that changing. Can I see a large corporate asset going bad? Now, in the past cycle, Lata, you always used to know every month there used to be some thousands or tens of names which used to be get thrown around, right? So, this guy is going bad, that corporate is going bad. That's not happening at all. So the benign credit quality continues. So you are at a low credit cost environment. You run at a 1.1% ROA. There's no risk to that, and your leverage is high at 14%. So you 14 times. So you have a 14% ROA, which is as good as that of a private sector bank, and available at one time price to book in certain cases even below that. That makes us a little bit more positive on PSU banks this cycle, I would say.
Yeah, a huge outperformance is what you are, pointing out to in SBI. From underperform, you have straight away taken them to outperform. Any other PSU banks that you will now start coverage or on which you're positive?
No, we can't talk about what we would do it in future, but specifically stick to the larger ones is what our call is. Yeah.
Okay. I think BOB is also in your coverage. Let me come to now the private sector banks. Actually, what stood out in that large table in your report is that only in HDFC Bank, the EPS growth continues from FY26 to 27 to 28. Whereas it seems to peak off for a bank like ICICI and Kotak. FY28 is lower earnings forecast compared to FY27, though 27 is much better than FY26. So, therefore, would that be your hierarchy? Prefer HDFC Bank over the others?
Yeah, so look, I think, of course, in the near term, markets are looking, Lata, beyond earnings growth. They are looking definitely at deposit growth performance for HDFC Bank, and the fact that the LDRs went up this quarter substantially has not been taken well. The deposit growth performance has been for this quarter, particularly HDFC Bank, has been subpar. So the markets would want a better deposit growth. So at the end of the day, the valuations and the multiples and the performance, the outperformance is not a function of just one earnings growth number. It's a function of a multitude of factors. So HDFC Bank is to get the deposit growth equation right. In the meanwhile, our preference is more towards a little bit high beta banks like an Axis and to some extent SBI. Because there the trajectory, for example, Axis Bank, if you look at our earnings growth number for FY27 is 30% plus, because it's coming off against the weaker base of FY26, and that's where the opportunity lies in, and the valuation is also cheaper. So we're playing for that particular valuation catch-up game. ICICI, as you know, also has an uncertainty surrounding the CEO tenure, because we really don't know whether Mr. Bakshi gets another full 3 years and maybe, he decides to leave or whatever could be the outcomes at that point in time. So therefore, there are some near-term concerns amongst the large two names, and therefore we are advocating a tactical shift in the near term towards cheaper valuation banks, be it an SBI or an Axis Bank, and when there is a valuation catch-up trade and there is a visibility of ROE that we see.
Okay. Time permitting, I'll come back to banks. But what about the two other companies that have captured the market's attention, Paytm and PB Fintech? Do you think those deserve a bigger look in now in the Q3 numbers?
Yeah, look, I think, to be honest, we of course upgraded Paytm, and we have been quite a long, we've had a bearish track record on Paytm. But look, at the end of the day, what matters is EBITDA. And these EBITDA numbers, which are getting reported by both Paytm and PB Fintech, are without any adjustments, right, Lata? So we are not looking at some core EBITDA excluding certain ESOP costs or excluding certain one-off items. So they are actually going towards EBITDA margin being positive and getting that operating leverage into the business. And Paytm has done a pretty good job about getting into that process of delivering the operating leverage. Now, of course, the debate is how long can you sustain? Now, if you can indeed demonstrate the operating leverage continuously and surprise on the upside with respect to EBITDA numbers, then these stocks have further upside. Now, the way we look at it here is that typically the new generation companies, Lata, across the space, they trade at 50 times FY28 EBITDA multiple. That's where our target prices are converging, and therefore we get more like a neutral rating. But remember, it's a combination of a numerator and a denominator. If you can surprise well on the upside, on the EBITDA, the denominator, you of course have a greater upside on both Paytm and...
There is this problem with new age companies. Very quickly, I want to get to the mid-cap private sector banks. You know, the Federals, the RBLs, the City Unions. Where do you stand of their AU Finance? Where do you stand there?
Yeah, see, look, I think, Lata, we will have to understand that the expectations are running a little bit high on some of these names.
Okay.
Some of the names are both, some of the smaller ones, as you know, we don't cover them, but they have got capital and the market believes that there can be a turnaround. But let's admit, Lata, there are structural issues. Getting few senior management at the senior level in some of these organizations is not necessarily going to completely change the outlook of the picture. There are a lot more structural rigidities in some of these older private sector banks, which is not easy to turn around. So my preference is towards the likes. For example, we cover City Union Bank. Time-tested model, 90%, 99% of the assets are secured. They restrict in their core domain of SMEs and Southern India and can generate a 1.5% ROA. I would rather believe somebody delivering that number rather than buying a stock on a hope of delivering a 1.5% ROA.
Okay. Well, fair, out of time, but that's excellently argued. Thank you very much, Suresh Gadpati, for joining us. And I'll take a rain check from you to invite you once the major results of the banks are out. Thank you very much for joining us. But that prepares us for the banking results and the finance company results ahead. Wrap up on Bazaar on that note. Chartbusters up next.